What if I told you your mortgage rate has less to do with you than you think? Two people, same house, same income, same credit score. Yet, one pays hundreds more every month for 30 years. Why? Because mortgage rates aren't just numbers, they're decisions. And those decisions happen long before you ever apply. Today, I'm breaking down exactly how banks decide mortgage rates, what really moves them, what's just noise, and how this system quietly decides who wins and who overpays. Watch till the end, because one small detail here can change your entire financial life. Most people think mortgage rates work like this. The bank looks at me, decides how risky I am, and gives me a rate. That is only half true. Here's the real order. First, the global money system sets the base cost of money. Second, banks price loans on top of that cost. And only then does your personal profile tweak the final number. Meaning by the time your credit score even enters the picture, the rate is already mostly decided. So let's rewind. Banks don't lend their own money. They borrow money first, and then they lend it to you at a markup. That borrowing happens in three main places: central bank lending, interbank markets, and bond markets. When the cost of borrowing rises for banks, mortgage rates rise. When it falls, rates fall. This is why central bank interest rates matter so much. When rates are cut, money is cheap. When rates rise, money becomes expensive. But here's the twist most people miss. Mortgage rates don't follow central bank rates instantly. They follow expectations. If markets expect rates to rise next year, mortgage rates can rise today. Banks price the future, not the present. Now we get to the real boss, the bond market. Most mortgages are bundled together and sold as mortgage-backed securities. Investors buy these bonds and demand a return. If investors want higher returns, banks must offer higher mortgage rates to make those bonds attractive. Think of it like this. Mortgage rates aren't just for borrowers. They're for Wall Street buyers. If bond investors are nervous, inflation is high, or economic risk increases, they demand more yield. That demand pushes mortgage rates up. This is why mortgage rates can rise even when central banks pause. The bond market doesn't care about speeches. It cares about risk and return. Inflation is a lender's worst enemy. If a bank lends you money at 4%, but inflation runs at 5%, they're losing purchasing power. So banks price inflation into your mortgage. Higher inflation expectations mean higher mortgage rates. That's why rising food prices, rising energy prices, and rising wages all indirectly push mortgage rates higher. Even if your personal finances are perfect, inflation alone can wreck your rate. Banks aren't predicting you. They're predicting the economy you'll live in for the next 30 years. Once the cost of money is set, banks add their margins. They add operating costs. They add default risk. They add regulatory costs. And finally, they add profit. In risky times, banks widen margins. Not because borrowers suddenly got worse, but because uncertainty did. This is why two banks can offer different rates on the same day. One bank wants growth. Another wants safety. Mortgage pricing is strategy, not charity. Only now do you enter the equation. Banks ask one brutal question. How likely is this person to default? They look at your credit score, your debt-to-income ratio, your employment stability, your down payment size, and your loan-to-value ratio. Lower risk means a lower rate. Higher risk means a higher rate. But here's the uncomfortable truth. Your personal profile usually shifts the rate by fractions, not full percentages. The big swings come from the system. That's why improving your credit score helps, but timing the market helps more. Now comes the choice that feels emotional but isn't. Fixed versus variable. A fixed-rate mortgage is priced higher because the bank takes the risk. They're betting rates might rise, and they lock you in today. A variable rate mortgage starts cheaper because you take the risk. The bank shifts uncertainty onto you. Choosing fixed versus variable isn't about comfort. It's about who absorbs future chaos. And banks price that uncertainty very carefully. They're not guessing, they're hedging. Mortgage rates feel unfair because they change daily. They react to invisible forces, and they punish bad timing more than bad behavior. Two identical borrowers, different years, wildly different outcomes. That's not personal. That's macroeconomics colliding with long-term debt. And banks? They're simply the middlemen. Here's the takeaway most people never hear. You can't control mortgage rates, but you can control when you enter the game. Understanding how banks decide rates gives you leverage, because the biggest mortgage mistake isn't choosing the wrong house, it's borrowing at the wrong moment. If this video changed how you see interest rates, hit like, subscribe, and share it with someone about to buy a home. Because knowledge doesn't lower rates, but ignorance always raises the cost.